Well, thanks everybody for being here for this lunch session. I just said to Lane and Brad in all the years that I've been involved with Springboard, this is by far the most well-attended lunch session. And that combined with the incredible Family Feud content a little while ago, when I walked in, Lane said, Shane is cooler than you, he's younger than you, he's hipper than you, he dresses better than you. And so they totally upgraded from a content chairman standpoint. Well, evidently they upgraded the content as well. So thank you, Lane, for pointing that out. I stand here very happily on the backside of a 9-month process in which Hand and Stone completed a successful exit from Living Lightman Capital Partners to Harvest Partners. Somebody whooped on that. Couldn't agree more. And so I get to be on this side of this panel, where I'm very, very happy to be. We'll start. Let's just go down the line and introduce ourselves, and we'll go from there.
Yep. There we are. Hey, everyone. My name is Grant Marks. I'm a principal and head of franchising with the Riverside Company. We are a global private equity firm focused on what we call the entrepreneurial end of the market, which is really just means for the community here, we partner with emerging brands up through kind of scaled mid-market companies and everything in between, working with businesses as they are scaling, growing, professionalizing, and helping them along the way. We've partnered with over 40 different brands on 4 continents, 10 in the last 12 months, so we're highly active and in all sorts of different categories, from home services to senior care to commercial services and QSR. So glad to meet everyone, and I'll turn it over to friend Jim.
Thanks, Grant. Hi, everyone. I'm Jim Waskovich. I'm the founder of Princeton Equity Group. I think got a little sponsorship here, which I love. We are a little unique in that all we do is franchising as a private equity firm. In our first fund here and pre-fund, we've invested in over 25 franchisors. Almost all of those are services franchisors. We love services. Brands like Massage Envy, European Wax Center, Sola Salon Studios, Urban Air, D1 Training, 5 Star, to name a few, LA Mental Health. We love working with founders. That is our job. You would think it's putting capital into businesses, but the real job is working with founders to build franchise brands we all know and revere. So it's a lot of fun. We're in Princeton, New Jersey, and Dallas, Texas. We have a 16-person team, one of the largest teams in franchising. It's nice to be up here. Thank you.
Thanks, Jim. And also thanks to Brad and Lane for putting on a great event. It's really amazing how many people are here. I mean, I think it's 560 this year, which is terrific. Well, nice to meet you. Pat Gallagher from Boxwood Partners. We are a sell-side advisor. About 50% of our practice is in the franchising space. We've represented a lot of franchisors who are in this room and have a few current clients in the room. We have done about 30 transactions over the last 4 years in the franchisor space, and look forward to hopefully shedding some information that you all find helpful.
Hi, everybody. My name is Jake Baer. I'm a director on the assurance side at BDO. We're a national firm, got offices across the country. I focus on the audit side. I've got a handful of franchising clients and have been in that game for about 8 years. We're a larger firm. We've got consulting in all branches to service our franchise partners in every facet. From the audit side to the consulting side, sales side, due diligence, you name it, we can cover you. BDO, I think, has been a partner with IFA and the franchising family for, I think, 25 years, and it's a relationship that we love, so we love being here. We love being invited every year. This is my first Springboard, and it will not be my last.
Awesome. So quick level set on the room. By show of hands, raise your hand if you are a franchisor. Okay, raise your hand if you are a supplier. All right, back to the franchisors. Raise your hand if you are not yet royalty self-sufficient. So EBITDA positive, but not yet royalty self-sufficient. Raise your hand. Okay, how about EBITDA between 1 and 3 million? Raise your hand. Okay, and then EBITDA 5 million plus. Raise your hand. Now, wait a minute. That was definitely not all the franchisors. So let's try this again, okay? Raise your hand if you are not yet royalty self-sufficient, even if you're EBITDA positive. Raise them up. We want to know, we're trying to get a sense of the crowd that we're talking to, so raise them up. Okay? EBITDA of 1 to 3 million, raise them up. Okay? And 3 million plus. All right, on the supplier side, same thing. Raise your hand if you're still burning capital. Nobody's willing to do it. Raise your hand if you're $1 million to 3 million in EBITDA. How about 3 million plus? You guys are liars too. So the reason I bring up the supplier side, right, one of the things, and I'm totally off script and we haven't even started, one of the really unique aspects of what we've seen over the last couple of years is that private equity is starting to get into this area of franchising as well. I know there's a couple of people in the room that have done equity capital raises in the last year. And so these guys are expert at it. That's why we're here. And while we typically in this session are talking to franchisors, I think what we really want to do is open up this conversation and talk to anybody who's in that kind of area of sub 5 million in EBITDA and thinking about doing a transaction. Last level set. Either side, raise your hand if you think you're going to sell your business in the next 36 months or do some sort of capital raise in the next 36 months. Raise them up high. There you go, guys. All right. So let's just start with some kind of high level concepts, right? We know there's a ton of equity that continues to roll into the franchising space, either on the franchisor side or on the supplier side. But not all deals are the same, right? So maybe let's talk about the different types of deals that are getting done, and each of you can take one. So Jim, you'll start with just a traditional PE deal, right?
Sure. Yeah, happy to. Yeah, so I think we're going to go through each deal type. Private equity is kind of a general term. It's really more of a fund structure when people say private equity. The way it works is we raise a fund of committed capital. Our investors are typically large institutions, university endowments, insurance companies, state pension plans. They commit that capital to a fund, and then we invest that capital, in our case, in franchisors. So that strategy, that fund structure could be used in venture, which we'll talk about, growth equity, and then, of course, where I spend time in private equity. Our focus is really around control investments, but with substantial founder rollover. I think the most typical percentage of a business we buy is 52%. So we have a lot of folks doing 51 and more. Most private equity investors are control investors. Often it's a requirement of the capital we manage. So I think one misconception out there is that it's all or nothing. You either have to part with 100% of your equity or not. And the reality is we love nothing more than, and it's actually kind of a requirement for us, for the founder to be part of the next inning. So that's sort of our mentality. We will often also use some third-party debt in our deals. So if you've ever heard of the term LBO, leveraged buyout, that really is signifying that there's some debt on the business that really allows us to pay more for the equity we buy. So that's a quick introduction to private equity. It describes a lot, again, a lot of strategies, but usually when people talk about private equity is that control-oriented partnership with a founder or management team.
Great. Patrick, can you draw the distinction between that and what might commonly be referred to as growth equity?
Yeah, thanks, John. Just to follow up on Jim's comments, growth equity is really for younger, more emerging franchisors to get you to that next phase of EBITDA positive growth and being able to fund yourself. So the one key difference is obviously you're selling a minority of your business and bringing on a partner. And the things to be careful on bringing on growth equity is a lot of growth equity actually takes control of the company, even though they don't own a majority of the company. So we encounter a lot of franchisors who might have taken growth equity 2, 3, 4 years previously, who didn't really realize what they agreed to when they signed documents. And not to give a plug out to Lane, but make sure you have good legal advice and bring on an advisor before taking on growth equity, because we see it so often where founders get diluted down, they lose control, and they haven't been able to take any money off the table. And even if the brand's growing, building out units, and the brand has great unit level economics, you can end up giving away a lot of upside in the future by doing a bad growth equity round early on in your growth stage. So, just be really careful, make sure you get good advice. Growth equity is very valuable, but it can come back and bite you years down the road if you didn't understand what a participating preferred share was versus just a minority common round, et cetera. And you might as well sell the whole business in some cases. So
Great, thanks. Grant, there's another very prevalent type of transaction that's happened. Really, I mean, it's been going on for a long time, but it's really accelerated over the last couple of years. And that's consolidation play, right? Where a strategic is buying multiple brands and consolidating them under a common flag. You guys have more than a little experience in that. Can you talk a little bit about that?
We do, yeah. We've implemented that strategy in several of our platforms over 20 plus years now. Started with the Dwyer Group in 2003. We took that business private. Actually, it was traded pretty thinly on pink sheets and was 8 brands when we started. We then endeavored to do exactly what you're describing, kind of consolidate and add services and continue to add brands that expanded our capabilities. Wound up selling that business in 2013 to another private equity firm, bought it back in 2016, sold it again in 2020. So we've been, we have a well-established playbook for doing just that. And I think the one thing that's changed about the private equity community over time and in that 20 years is that when we took Dwyer public, it was healthy, profitable, and multiple brands to begin with. I think where we're starting today is that we're saying we're comfortable working with emerging brands that might aspire to be a mini version of Dwyer Neighborly over some time. And so we're starting smaller. In some cases, Jim was referencing using leverage. It's not appropriate to leverage a business that's not generating cash because you can't pay down your interest, right? So we're starting smaller, working with more emerging brands. We think it's great because it's more white space. There's more opportunity for us to bring some of the change management and support and resources and technology and infrastructure to help those businesses grow more quickly and methodically and not kind of get too far ahead of their skis. And so we've been doing that again now in a separate residential build-up called Threshold Brands. We've done it in the senior care industry in 2 different instances, and we're doing it in commercial services as well. So it's kind of a newer trend within the private equity world, and we're seeing it more and more frequently. Private equity firms kind of coming down to everyone in this room's market, where everyone here is relevant to private equity.
Yep. So that's a great segue, and thank you, all 3 of you, for those descriptions. Just loosely, because I know there's no rule of thumb, but as you think about those 3 different transaction types, what are the EBITDA thresholds? So let's start on the PE side. I mean, Jim, for Princeton, but also more generally, what are kind of the EBITDA thresholds for a PE deal?
Yeah, so for us, we really like companies that have at least 2 or 3 million of EBITDA on the low end, up to maybe 15 of EBITDA on the higher end. That's kind of our sweet spot. We call that the growth end of the franchisor market. So the brands are obviously established. Maybe you've got 50 to 250 locations open, but you really want some help getting to 1,000. And the skill sets required to get to 50 or 250 are very different than the skill sets required to get to 1,000. Yeah. So that's kind of the range for us. And then,
yeah, Pat. I mean, as you think about growth equity? What's the range?
Well, I think growth equity can be any range of EBITDA. I mean, because it's growth equity, so by default, you're not spinning off cash flow yet, and you're trying to raise money to help grow the brand. The other thing I want to point out on a buyout sell side deal, all EBITDA is not created equal, and we have a lot of clients who come to us with $5 million of EBITDA. By the time we clean their books and recast their P&Ls, they have $7.5 million of EBITDA. So. And we've been particularly very successful at pro-forming out sold but not yet open locations and being able to justify, a kind of a maturity curve for your franchisees out 1 to 2 years. And we see private equity groups giving credit, not full credit, but credit for sold but not yet open locations. So, you hear a lot of sporty multiples in the marketplace. You really have to look at what EBITDA those multiples are being, kind of quoted off of, because more often than not, our clients think they're at 5, and we go out to the market at 7.5, and we expect private equity to, kind of either buy it or not. So it's that they do their quality of earnings study, we do ours, and then it's just a negotiation from there. So.
We're going to talk about the transaction environment in a second, but that last point about being able to perform a future growth and getting paid for it in today's valuation, is that a function of this, recent transaction environment, and do you see that changing, or is that here to stay?
Well, maybe I'll. So I would say that what we're seeing is that in a hot market, obviously, you actually, as a buyer, you want the justification to pay more and win. It's actually kind of funny. You would think as a buyer you want to pay less. You want to figure out how to pay less, but that means you own nothing at the end of the day. And if you want a high-quality asset, you've got to do the math exactly that, as Patrick was saying. So I think that math is here to stay. I think people know how to do it now. People have been trading off of that math for a while. So I don't think if the economy softens, we're going to start doing the math differently. I don't know how you see it.
Yeah, I would obviously agree with that. I think that the key is creating a competitive tension when you go out to the market, whether you're raising minority equity or you're doing a majority deal. If you have 3 or 4 or 5 private equity firms or aggregators looking at your business and they fall in love with it, they're gonna buy into your EBITDA in 2024. I mean, you want to. It's like buying a great piece of artwork at an auction. You can't really value it based on what it sold at 3 years ago. The key is making sure your brand, your books, all your legal docs, you take all those issues off the table and you try to get the investors to really buy into your company, your brand over the next 24 to 36 months. And that's what gives the ability for people to buy into the pro forma of sold but not yet open locations. So I don't think that's going away. The market is getting softer. You can't have the NASDAQ down 30% and not expect valuations to soften a little bit. And debt has gotten tremendously more expensive. So we were softly involved in John's deal, and there's a window of time here where debt is getting much more expensive for private equity to fund deals. So they really have to fall in love and over-equitize at this point.
Yep. Grant, you wanted to add something to that?
Yeah, I was going to add 2 points. One being I fully buy in and believe that, the sold not open adjustments that Boxwood has made a solid living on are here to stay, and for good reason. And it's a trend, not just in the franchisor community, but I've seen it in multi-unit franchisees, so in more traditional retail settings where, whether it be Planet Fitness or other, big brands, that's a concept that's been going on for 4 or 5 years. The other thing I'll say, just to mention that there are private equity firms that also, start below 2-3 million of EBITDA out there, and will value your business probably more highly on the basis of your royalties, and maybe be a little bit less focused on your absolute EBITDA. But and that's a trend that I think is also emerging and becoming more prevalent.
Just to put a final note on this topic, Grant, in the consolidation world, right? Is there a EBITDA threshold? Do you see brands that are not yet
I
profitable
might not be the
trading?
right person to answer this because the answer kind of is consistent for us. We remain willing to do pretty small deals. So by way of example, we actually bought a business that's not franchised and is just a single corporate-owned location that we're going out and franchising for the first time. And so we are more willing to consider when we already have a family of brands. We've got 8 different brands under the Threshold umbrella, 9 today, and a healthy base of EBITDA in that business as well. We're more willing to consider emerging brands that may not be generating cash, and will fund some losses for a period of time because we believe that this is going to be a 150, 200 unit business by the time our hold period is over. So yeah, that's kind of our experience, but
Okay.
I don't know if others.
Great. So clearly the transaction environment remains strong, right? There's a significant amount of capital that wants to continue to invest in this space. What are investors looking for? What is it that they're attracted to? And we've got a couple specific concepts to address, but I guess I'll just start with, what are investors looking for?
So I think it comes down to unit economics, right? We call it our 3 lenses that we look at every investment through. The first lens is unit economics. It has to be, the 4 walls have to be a good deal for the franchisee. If they're not, they're going to be a bad deal for everyone. The next thing we think a lot about is fad risk. We try to look for brands that have proven out the concept, typically over 50 or more locations. The more you can de-risk the fact that the concept works in multiple places, I think the greater your value will be. And the last thing we think a lot about is recession resistance. So a lot of the services businesses that we focus on actually hold up really well in a downturn. And if you think about the typical private equity buyer who's going to probably need to put real debt on a business in order to afford the purchase price in this environment, you need the EBITDA to be there even if the economy gets tougher. So those are the 3 things we look for. And then on top of all of that, it's about the founder, right? We need to be backing somebody that we actually like spending time with. Life is short. If the person is someone we don't want to spend the next 3 or 4 or 5 years with, it's very easy to move on. Often the teams we inherit are incomplete. That's fine for us. We're happy to do it, but we really need that founder that is the glue and the person that we're rallying around. So that's what we look for.
Okay. Grant or Patrick? Yeah, whichever.
Well, I would definitely echo Jim's. One of the first things we look at when taking on a client is unit level economics. So, and how well that brand validates. So, when you do like an FBR study, or you're actually, really, if you're thinking about going to market in the next 2 years, make sure your franchisees validate well. Make sure the unit level of economics. I would rather have a brand making less money at the bottom line that validates well and has good franchisee profitability than anything else. So that is key. I would say the management team, I would go beyond the founder and just say the management team has to be really strong. A lot of our founders exit fairly soon after selling, or even the management team. So we really want to make sure the next level that your CFO, your fran dev, your marketing team is all really strong. And also invest behind your brand. Good public relations, good marketing is key. Most private equity firms are looking for that brand that they can take across all 50 states and grow the location base. So even if you're only 50 or 100 units, if you've built a good brand, you have a good management team, and your franchisees are making money, private equity is going to pay up for you. So those I would just kind of take it to that next level. That building out your management team and investing behind your management team is critical if you're thinking about potentially having a liquidity event. So,
Grant, do you want to add anything to that?
Yeah, I'll add a couple of things. I think I echo everything that Jim and Pat said. I think we pay For growth, absolutely. We pay, like I mentioned, for really steady, predictable royalty streams. It's part of the reason that I think all private equity is so attracted to the franchising industry. And I would just underscore kind of on the softer side, like culture is very, very important to us. People are very important to us. And so we're similar in some ways in that we encourage like participation in a deal. We want a founder who believes in the future of their business and is willing to, put hard dollars up against that. We think it's a good litmus test for, do you believe in what this business can be in the next 5 years? And so, we kind of, the same way franchisors and franchisees, it's such a beautiful alignment model. We try to do the same thing where we create alignment in our deals with our selling shareholders.
Right. From a consumer proposition perspective, how do you think about differentiation, and how do you think about the competitive environment that a brand's operating in, and how does that have an impact on potential investors?
Yeah, so I think what we look for is some amount of market leadership, right? All of our brands operate in highly fragmented, very large markets. So chances are you're not going to have 10% market share or 15% market share, but we want to see that there's some leadership, and the leadership could be momentum. Maybe you're growing faster than anyone else. It could be you've got the best unit economics. Maybe you're strong regionally. There's got to be something that is special and better than the other players out there. But I think a thing that people looking at franchising and the kind of investing we do don't get is this very differentiation point. And we really think about the differentiation, maybe not so much from the customer standpoint, but more from the franchisor standpoint. It's pretty easy to go and open a massage business or a waxing business, but opening 800 of those, managing 800, building the team that can manage 800, that's actually highly, highly differentiated. So that's the kind of way we think about it, because at the end of the day, we all operate in these very fragmented markets where it's rare to have real meaningful market share, and traditionally defined.
Right.
The only thing I'd add to that is, having good, customer pull-through, having good national marketing at the franchisor level can definitely help increase valuation. So, making sure customer reviews online are positive, all the things that, we'll get a phone call, hey, have you seen your client's reviews on? You got to make sure that you're doing everything you can to, make sure the marketing and the brand of your company is meeting the consumer need, and there's not a lot of negative out there. So I would just say, the devil's in the details, and private equity buyers will look for any reason to knock down valuation. And so, simple things that you can get right up front can definitely help in a process, and making sure you're really filling that consumer need is a key.
I'll just quickly validate Pat's point that for every deal that we do a lot of service-based brands. We do a market-by-market study where we look at Google, Yelp, Angie's List reviews of every single competitor by market. And, I wouldn't say we ding businesses for it, but we look closely at it, and it's important to us. And, the ones that clearly are outperforming, we absolutely get more excited about.
Yeah, the bigger the deal, the more detailed the diligence. Just to put that in perspective, in our transaction, we did 12 management meetings. All 12 of those groups hired either BCG, McKinsey, or Bain to do deep market studies, not just on our core business, but on all the tangential aspects of our business. So that may not happen based on the size of the deals that you're doing, but the diligence ramps up the bigger you get. Let's shift gears a second, because I want to give Jake an opportunity to participate. Thank you for being so patient down there, Jake. The founders that are in the room, if they're thinking about a transaction sometime in the next 36 months, right? Any one of these transaction types. What should they be doing now to prepare?
First thing is make sure your books and records are tight. You know, I'm an accountant. It's what I do for a living. It's not exciting. I get it. Y'all are out there trying to make money, sell franchises, and sometimes the books and records kind of fall to the wayside. But as soon as you decide that you want to make an exit strategy or bring on a strategic partner, whether that's focusing your team on it or bringing in outside help, make sure your books and records are good and that the information is accurate. The worst thing you can do is get into Q of E or any of the due diligence with these guys and have a landmine you didn't know about. Something blows up, the numbers don't work. You know, you want to maximize the value of your business, of, you know, the thing you're putting your blood, sweat, and tears into. You know, to Patrick's point,
Hey, Jay, can I stop you for a second? Just, what's Q of E?
Quality of earnings. So you do a study. So when these guys come in, it's, you know, we've made, you know, we had 12 million in sales. Okay, well, is that 12 million in sales something you can replicate? Can you grow with it? Is there actually quality behind those earnings, as opposed to, you know, we had one big customer that came in and just gave us a bunch of money, and that money's gone. It'll never be back again, right?
And so who does Q of E's in a transaction?
So you can do a sell side Q of E, where you do it yourself. So when the investors come in, you kind of hand them the work that you've done. A lot of times in due diligence, they'll come in and do their own. Not that they don't trust you, but you know, they trust their guys more. And to Patrick's point, you know, he said he's come in and said, you know, someone says they got 5 million EBIT, and all of a sudden it gets to 7.5. That's great. You don't want to go the other way. You don't want to hand these guys a package that says I got 7.5 million in EBITDA, and they come in, tear it apart, and you got 5. One, it's embarrassing. Two, you know, your books and records are really the only thing that you can prove that what you're doing, other than selling yourself. You can't lie with the numbers. They are what they are. So, you know, the more you can get in front of that, and then, you know, I kind of call it a defensive due diligence, where you look for your own weaknesses. You find those areas that you're weak in your company or things that you need to shore up, and you do that ahead of time, so that when you've maximized that value, when these guys come in and they start knocking, as opposed to them finding it and saying, whoa, what's this thing over here? This is going to cause a problem. And then in an environment where we're at now, with interest rates going up every couple months, you don't want to slow this process down at all. You know, if they get in, there's an issue, and it takes you 6 months to get the books and records right, you may miss out on a deal. The valuation may come down just because the cost of capital has gone up so much.
That's great. Along those same lines, and Pat, you want to?
I was just going to preface that almost every one of our clients, we mandate that they do a quality of earnings before we go to market with them. So, you know, so almost every deal is having 2 quality of earnings done, one by the client and with us, and then another one by the private equity firm who's coming in once you go exclusive with one party. So almost every deal, I mean, that's why BDO and all the QV providers are very hard to book time with right now, because the market in the last 5 years has gone from doing 1 quality of earnings per deal to 2. So it's we want to know where all the landmines are before we go to market, and make sure that we model out everything and we know exactly what they're going to find in due diligence. You don't want to go exclusive with one party and then they find the landmine before we do. So
Yeah, but you know, the investment bankers will know this if you're working with one. But just to put this in perspective, it might take you 6 months to get a sell side Q of A. Right? If you decided you wanted to go do it today, to get through getting somebody on board to do it, and then getting the sell side Q of E done, it might be 6 months before you're really even ready to put something out. Okay. Along the lines of sort of things that you want to get done in advance of thinking about going to market. We talked as a group a little bit about some franchise agreement considerations that are important and that are potential differentiators. So for those of you that are, or for all of you that are in the transaction environment, what are some of those things? What are some of those franchise agreement considerations?
So this is a hard one here. Look, I think the franchise agreement, and one of the things that we've been impressed by is the quality of franchise counsel out there. It's rare that we find a brand that gets to the level where we're interested and their franchise agreement, their selling practices are a total mess. I mean, that's actually quite rare. I think there are a number of things you can do in a franchise agreement to make at the end of the day, it's how do you structure your offering to a prospective franchisee. And I think there's some things you can do in that agreement and with those terms to make the business more predictable. For example, one thing we often do post-close is we think about, is there some kind of a minimum royalty that makes sense? It's not appropriate for every business, but it can actually make a business, a franchisor, much more recession resilient, for example, and again, then allow a buyer to potentially use a little bit more debt and potentially pay a little bit more for the business. So there are a lot of tricks that can make, again, the offering, that core offering, stronger. But again, it's rare that we get to a concept that is 200 locations open and the franchise agreement is totally a disaster.
Just to follow on that, I would definitely, we see a lot of younger franchisors that give or negotiate franchise agreements early on to get their first 25 or 30 franchisees. Don't do it. Set the stage early. Make sure they understand the benefits of becoming part of your system early on, and don't. We hate seeing changes in franchise agreements. It sends bad signals to the potential buyers. I would make sure, and if you do make any changes, make them as an addendum. Don't make them in the franchise agreement. Just keep everything as standard as possible. And the other thing in franchise agreements, we see a lot of franchisors miss opportunities for rebate programs, and we've been very successful over the years of kind of working with our clients early on. What kind of rebate programs should be in your franchise agreement that once you get to 100, 200, 300 units are going to drop millions to the bottom line, so we can add those into the pro forma also. So I would get very creative, but that is one area that a lot of young franchisors miss early on, is adding in proper rebate programs.
Everything you guys said times 2 or 3. I would maybe just mention that, oftentimes, and this is not, specific to franchise agreements, but we dig straight into litigation history in FDDs, and I would say not all litigation we view as created equal, right? If someone has a minor discrepancy, argument with you, but is still buying, and opening new units, that's different than, I've got a multi-unit who is, actively taking me to court and is dropped out in the last 3 years, right? So we definitely put a lot of emphasis and pretty much open directly to that page the moment that we see a new opportunity.
Got it. So maybe the biggest consideration, right, in terms of deciding that you want to go to market at some point is banked or not banked, right?
Don't bank.
Two very different perspectives up here, right? So Patrick, maybe you take a quick run at, and by banked or not banked, meaning do you hire an investment banker or do you hire a professional to help you get through the transaction process, right? And what's the benefit of it, and what are the implications of that? So Patrick, want to take a run at it?
Well, this is pretty much a softball question for me, but I would just. I would never, when I sold my first company, I hired Lincoln out of Chicago. I would never, ever work my butt off for 5-10 years building a company and then sell it one off to one bidder. I mean, you lose all your negotiating leverage. You lose all the urgency for them to agree to your terms. You lose the optionality of, in our process, our clients meet 8 to 10 private equity groups, and they get to choose who's the best fit for them. It's not just pure economics. We have many clients choose the second or third highest bidder, which we hate because it costs us money. But we want our clients happy. We want our clients referring more franchisors to Boxwood down the road. And so we're very happy when our clients come to us a year later, and several have come to me during this conference and said, I can't believe I found the right partner. And so that's when we know we succeeded on a deal, is when our clients really found a partner to help them grow, and it wasn't just purely economics taking cash off the table. So
Patrick's going to run out the clock on this answer if I don't give the
Yeah,
other side a chance. So one of the two of you, right, banked or not banked?
We've done both ways. Actually, a lot of the founder deals we do are highly competitive, but the founder doesn't hire a banker. And look, I think if you're selling 100%, it's a very different story than if you kind of have your head down and you just want more help. That can be a different type of endeavor. You know, some brokers, bankers run a process that's sort of like speed dating with a shotgun wedding at the end. And maybe that's fine if you're selling 100% of your company, you don't care a whole lot about your legacy or what happens after you leave. But no matter whether you hire a banker or not, and there are fabulous, fabulous bankers out there, make sure you spend a lot of time with your prospective partners. Just like we're going to do diligence on you, you have to do your diligence on us. It is just too important to not know the person you're going to spend the next 4, 5, 6, 7 years with. So just like we check your validation, right? You have to check our references. Talk to the founders we've done business with. How did we act in the beginning? Was that the way we acted at the end? What are some tough situations that have come up? How did the potential buyer handle those tough situations? I really can't stress this enough. Again, whether you go the banked route or not, make sure you run a process where you can actually spend time with the 3, 4, 5 folks that are ultimately maybe the finalists or the ones that you like the most.
Great. I'll take one last stab at this. Outside of my tongue-in-cheek comment, I would say we have done it both ways, but you can take this in the spirit in which it's intended. We always hire an investment bank when we go to sell our businesses. It's because we're fiduciaries, we've got LPs, et cetera, but ultimately it drives outcomes. And so, we also prefer it a lot of times because it means that we know that BDO has scrubbed your numbers. We know that Pat and his team have prepped materials. We know that they've spent time with you to help get you ready. And we think that if we're at the final table at the end of the day, maybe we will be that party that's a little bit light on value and still there on culture and the right fit for you. But truly, we think that hiring someone doesn't have to be a formal investment banker. There's lots of great ones in the room. Someone who can help you along the path, advise you in some capacity, accountant, the attorneys that are here, Lane and team, they all can be good resources. So would encourage folks to, have that third-party validation.
Judging by the lack of movement in the room, we could continue on all day. Unfortunately, we can't. I committed to getting Lane and Brad a little bit of time back. So if you get a chance, grab one of these guys. I just want to say thanks. You made this incredibly easy. It was a great panel to lead. And thanks, everybody. Enjoy the rest of the program.